Full stock due diligence. Morgan Stanley. MS. Before you buy your next financial stock, stop scrolling, because Morgan Stanley might just be the powerhouse hiding in plain sight. But is it an opportunity or a risk disguised as stability? Let's break it down. Company overview. Morgan Stanley isn't just another Wall Street giant. With three powerful engines, institutional securities, wealth management, and investment management, it's built a business model that balances cyclical volatility with steady recurring revenue. Unlike rival Goldman Sachs, which leans heavily on trading, Morgan Stanley has carved out a more resilient foundation. CEO Ted Pick, who took over in 2024, is steering the firm into a new era of diversification and growth. Financial health. The numbers? Impressive. Revenue, $66.14 in the past 12 months, a major jump year over year. Net income, strong growth despite volatile markets. Profit margins, wealth management keeps delivering stable, high-margin revenue. Debt to equity, high, yes, but normal for the sector. Its liquidity and cash flow mean it's handling that debt like a pro. This is a company generating serious cash, fueling dividends, buybacks, and acquisitions. Valuation metrics. Is it overvalued? Not really. P/E ratio, 17.2x, slightly above peers but justified by its diverse business mix. P/B ratio, in line with industry, signaling balance sheet strength. Relative valuation, less volatile than Goldman Sachs thanks to wealth management. Growth potential. Here's where the story gets exciting. Wealth management expansion, targeting high net worth clients with acquisitions and products that lock in long-term loyalty. M&A and IPO leadership, positioned to ride the wave of capital market resurgence. Tech and AI investment, from smarter trading platforms to advanced client tools, Morgan Stanley is building the future of finance. Risks, but don't mistake it for bulletproof. Cyclicality. Investment banking revenue tanks when markets slow. Regulation and lawsuits. Heavy oversight, constant legal risk. Geopolitics. Global exposure means global headaches. During downturns, Morgan Stanley stock has historically underperformed the S&P 500. Dividends and returns for income hunters. Morgan Stanley shines. Yield, 2.6%, beating industry averages. Dividend growth, over 21% CAGR in recent years. Buybacks, aggressively returning value to shareholders. Market sentiment analysts, mostly bullish. Majority ratings, buy or hold. Price targets suggest upside from here. Institutional ownership above 50%, a vote of confidence from the big money. Technicals, trend, strong uptrend above moving averages. Momentum, outperforming the S&P 500, though RSI hints at a short-term pullback. Support resistance, key support at $139, 52-week high at $161. Governance and ESG. Morgan Stanley plays the ESG card with commitments to sustainability, though past controversies still weigh on its reputation. Governance structure emphasizes independence and accountability, moat and innovation. Its brand, client relationships, and wealth management switching costs create a fortress. Add in heavy tech investments, like AI-driven advisory tools, and the moat is widening. International exposure, big U.S. base, but global reach. That means opportunity and currency risk. A stronger dollar can hurt reported earnings. Final takeaway. Morgan Stanley is a cash-rich, dividend-growing, innovation-driven titan that balances steady wealth management with high-reward investment banking. But with cyclicality and regulatory risks looming, this is a stock for those who can stomach Wall Street ES roller coaster and want to collect growing dividends while riding it.